AI and semiconductor stocks are sliding into a technical bear market just as an energy price shock threatens to reignite inflation. You are watching vTalkInsight, Equity Pulse Daily for July 20th, 2026. Today we will connect the macro narrative of disinflation and central bank caution with a sharp rotation inside equities, from crowded artificial intelligence winners toward energy, financials, and select defensives. Macro data are sending a cautiously encouraging message. Market-based inflation expectations have dropped, with break-evens and swaps implying a much tamer 1 to 2 year inflation path than earlier this year, even as current consumer prices run around 3.5%. Softer consumer and producer price prints have pulled front-end Treasury yields down by nearly 10 basis points this week, and core inflation is decelerating enough for some houses to project nominal growth of about 5% this year. Despite that disinflation progress, the Federal Reserve is not declaring victory. Officials continue to stress their willingness to hike again if inflation fails to moderate, and markets still assign better than even odds to another move. At the same time, several major forecasters now see no additional Fed hikes in 2024 and even flag the potential for a cut if the current trajectory holds, arguing that policy may already have been restrictive for too long. Bond markets reflect this tension. The 2-year yield has slipped below roughly 4.12%, while the 30-year sits above 5% and the 10-year remains north of 4.5%, leaving the curve flatter than usual, but with hints of steepening. Yields are widely viewed as roughly fair value with limited upside, even if inflation falls toward target, which caps the scope for a big bond rally and keeps equity discount rates relatively elevated. There is also growing recognition that the lag between rate moves and real economic impact may be lengthening, complicating the Fed's timing and raising the risk that policy stays tight for longer than markets anticipate. Outside the U.S., the Bank of England is keeping quantitative tightening in place while gilt yields hover near 5%, helped by a political risk premium, and some strategists see the U.S. dollar at the start of a gradual multi-year depreciation cycle even though it remains strong for now. The biggest challenge to the benign inflation story is coming from energy. Escalating tensions between the U.S. and Iran, including strikes on infrastructure and tougher naval blockades in the Strait of Hormuz, have reduced observable crude flows through that key choke point by around 0.4 million barrels per day. At the same time, Ukrainian drone attacks have knocked out more than half of Russia's refining capacity, further constraining global product supply. The real stress is showing up in refined fuels. Crack spreads for products like diesel and gasoline have surged to levels approaching, and in some cases exceeding, the underlying crude price, with spreads of $70 per barrel over crude in parts of the complex. In New York Harbor, diesel is changing hands around $130 to $140 per barrel, and inventories across the refined product space are at record lows. These acute shortages sit on top of years of underinvestment in upstream oil, refining, and metals, while strategic reserves and commercial inventories have already been drawn down. That leaves the system with very little cushion against further disruption. Brent crude has jumped more than 4% this week to just below $88, and petroleum benchmarks have outperformed other asset classes dramatically year to date, reflecting how tight the balance has become. For growth, the risk is clear. Previous energy squeezes cut energy-intensive industrial output in Europe by roughly a quarter, and a repeat shock would be hard to absorb, with fewer policy tools left. For inflation, even if headline oil prices remain capped near the mid-80s by softer Chinese demand, the downstream spike in refined product prices threatens to reintroduce an inflation impulse just as central banks are trying to signal a pause, with obvious implications for consumer spending and margins in energy-intensive sectors. Against that macro backdrop, the main equity swing factor remains the artificial intelligence and semiconductor complex. The Philadelphia Semiconductor Index has now fallen 20% from its recent peak, formally entering bear market territory. Chip names have dropped close to 20% from June highs in just a few weeks, with some momentum heavyweights down more than 30%. Even though the S&P 500 as a whole is only about 2% off its all-time high. A key driver of this reversal is a rapid shift in the AI narrative. Chinese startup Moonshot has introduced its Kimi K3 model, which is reported to be competitive with leading U.S. closed-source systems despite lacking access to top-tier American chips. Investors are rotating toward cheaper AI options, raising questions about the long-term pricing power of high-cost U.S. hardware and contributing to heavy selling in stocks such as Nvidia, Micron, and Intel. At the enterprise level, AI costs are rising quickly. Many companies are trying to cap spending by using open-source models for routine workloads and reserving expensive proprietary models for the most complex queries, which could slow growth for some premium providers. Meanwhile, the investment focus is moving from model development to massive data center and infrastructure buildouts, where large U.S. technology platforms and their suppliers stand to benefit most from the next phase of capital expenditure. That infrastructure pivot is being financed in part through heavy bond issuance by the hyperscalers. Debt supply from these issuers is on track to approach $300 million this year, a sharp break from previous cycles, and their combined duration risk now exceeds that of the 6 largest U.S. banks. Investor demand has started to flag, with wider concessions on new deals and underperformance in secondary trading, raising the prospect that continued heavy supply could pressure spreads across the broader investment-grade market. Yet the structural AI story is far from over. Analysts still see the AI cycle in its early innings, with the application and infrastructure layers expected to capture most of the long-term value, and firms like OpenAI and Anthropic maintaining a clear technological lead. Alphabet is viewed as narrowing the gap in AI infrastructure and applications. Databricks is delivering accelerating revenue growth that underpins a high private valuation, and Apple's recent share gains appear driven by its perceived safe haven role inside tech, thanks to devices that remain central to AI consumption and a more cautious stance on capital expenditure. Outside the AI complex, the earnings picture is unusually strong. In the S&P 500, every one of the 44 companies that have reported so far has beaten expectations, an exceptionally high hit rate that is supporting overall equity sentiment. In Europe, earnings revisions are broadening, with around 80% of sectors seeing upgrades at a time of year when downgrades are more common, and European financials, especially banks, stand out with particularly strong upward revisions. Major Wall Street banks are also delivering standout numbers. Second quarter earnings have grown at annualized rates above 20%, helped by record trading and investment banking revenues and by workforce reductions of more than 10,000 employees across the group. Even so, there is open skepticism about how durable these conditions are, given elevated debt levels in the real economy and ongoing quantitative tightening that could eventually reprice funding costs and credit risk. Market leadership is rotating rapidly. Flows are moving away from semiconductors and hyperscalers and into sectors like healthcare, dividend payers, and financials, which are perceived as more defensive and, in some cases, supported by earnings upgrades rather than the AI trade alone. Market breadth has improved markedly, with about 65% of S&P constituents outperforming the index over the past month, compared with just 12% over the prior year, even as volatility gauges have crept into the high teens. Several company-specific stories highlight this broader dispersion. Netflix shares are under pressure after a disappointing sales outlook, softer guidance, and plans to reduce the frequency of engagement disclosures, even though its advertising revenue is projected to double from $1.5 to $3 billion, and it is experimenting with short-form content, live sports, and gaming. In contrast, Saab has rallied strongly after beating second quarter profit expectations and announcing plans to double annual production of its Gripen E fighter jets on the back of Ukrainian orders and prospective Canadian collaboration, underlining the structural tailwind in defense spending. Luxury and sportswear names show how selective consumer strength can be. Burberry has posted its first sales growth in 3 years, with 5% comparable growth and improvements across product categories, driven by strong demand in the U.S. and encouraging, if slightly below forecast, trends in China. Adidas, meanwhile, has gained a marketing edge over Nike around the World Cup, with both finalist teams and high-profile players wearing Adidas, supporting its recent share price outperformance and reinforcing the value of marquee events for brand momentum. Stepping back, equity markets are balancing three powerful forces. Disinflation data and strong early earnings support the soft landing narrative, but an extreme tightening in refined product markets is reviving inflation tail risks, just as policymakers hope to pause, and the AI and semiconductor complex has swung from market leadership into a full bear market. For now, the S&P 500 remains close to record highs with much broader participation under the surface, while volatility edges higher and positioning stays heavily skewed toward equities over bonds. The key questions from here are whether energy prices force central banks to stay restrictive for longer, how deep the semiconductor and AI correction runs, and whether earnings momentum in banks, European cyclicals, and select consumer and defense names can offset those headwinds. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.